很多朋友住212，反正就这两个地方。
East or west of Savannah.
I guess you could go, yeah.
But yeah, this is.
Like to.
我也打算回去，在这里已经快抑郁了。
We're gonna hit the ground running. So I wanted to pass along takeaways from the midterm exam. So hopefully everybody saw the grades. But I want to walk through a couple common areas where I saw some things and kind of explain what was going on. So there were a couple questions. Remember when I asked you, I gave you different scenarios, different sections where I talked about, okay, if this was done as a sole proprietorship or if this was done as a corporation, here's the amount of the income and then what's the after-tax cash at the end of the day. So what I was looking for, if it was a corporate setting, right, compute the corporate tax, which is income less expenses, kind of 21%. 79% is left over. That is dividended up to the shareholder. It gets taxed, and I gave you the shareholder's tax rate. Well, it's after that tax, after the shareholder level tax, that's the net tax you get at the end of the day. Trying to explore double taxation, right? That you're going to pay tax at the corporate level and tax at the shareholder level. Contrast that with if I just said if this was done as a sole proprietorship, obviously I avoid the corporate level layer of tax, just tax at the shareholder level. So I saw different things going on there. Some people took a DRD. There is no DRD in an individual setting. Right? Dividends received deduction is only applied corporation to corporation based on the level of ownership. So no DRD. I saw some things where people didn't compute the corporate tax first and then try to layer on the individual tax. So what I would suggest you do is just draw out the picture. Like, what are the facts telling you? Here's an individual owning a corporation. And if the income's at a corporation, that's the tax, and then pick it up a level if there's a distribution. So some things are going on there. Second area, the base for the 163J, the interest expense limitation, is 30% of EBITDA, right? Earnings before interest, dividend, or depreciation and amortization. Okay? Interest, taxes, EBITDA. So the question gave you taxable income of 1.5 million, which includes $200,000 of depreciation. So that's in the 1.5, right? I don't think that's misleading. It includes that, it's in there. It's already been reduced to that. So you got to go back. You got to add back the 200,000 to get to earnings before interest, taxes, depreciation, amortization. So the base should have been 1.7 times 30%. I saw a lot of 1.5s times 30%. Right? It's not taxable income times 30%. It's EBITDA times 30%. Okay. The depreciation calculation using the tables that were provided. Lots of people didn't do the mid-quarter test, right? First, you do the mid-quarter test with greater than 40% of the assets placed in service at the end of the fourth quarter. That puts you in the whole series of table 2 tables. And then each asset, not just the ones that caused you to be in the 40%, is either 2A, 2B, 2C, 2D. Okay? So I was a little surprised everybody just didn't face the depreciation calculation. Book tax differences, obviously there was several things in book tax differences. If you didn't do well in that section, you're going to struggle on stuff we're going to talk about this week, because it's all building on that, right? So there was one, remember the acquired goodwill question, and I wanted to do 3 years. So we had acquired goodwill on an asset acquisition. So we know we have goodwill amortization for tax purposes, right? 15 years we acquired assets. And the book treatment was impairment. And I told you 2 years of the 3 years that had a goodwill impairment for book purposes. So what I was looking for is for 3 years, what happens for book, what happens for tax in 3 columns. And then I asked whether it's temporary or permanent and whether it's favorable or unfavorable. Right? So some people really struggled in that area, and they struggled in the book tax difference parts of the multiple choice section. I did get a few, a handful, I would say, of giving me the cumulative difference, which is what we're going to talk about today. That specifically wasn't what I asked for, but I know where you were headed, and I gave 2.5 out of the 3 for that, because I knew you were getting the concept, you were just not directly answering the question. The reason I bring that up is when you finish a short answer, I think it's always helpful to revisit what was the specific question asked, and did I answer that question? I think that's, again, trying to transition you to being a young professional. If your boss asks you a question, did you answer the boss's question, or did you answer the client's question? Ask the question you wanted to answer, right? So just go back and test that. Did I answer exactly what was asked? Frankly, I was disappointed in the last topic here that there was a section on the sale of the 1231 assets. Remember, section 1231 assets are assets used in a trade or business held greater than a year. So into that. That's the best of both worlds rule. That required you, I gave you the amount realized. You needed to compute the adjusted basis, which was initial basis less accumulated depreciation. Subtract the adjusted basis from amount realized gives you your gain realized. And then you have to recapture the depreciation, the gain up to the amount of the depreciation. I had excess gain. That was capital. But the question again asked, what was the amount? What was the character? So you had to then bifurcate the gain between the depreciation recapture, which was ordinary, and the other was long-term capital. So I had lots of different variations of that where people got stumbled. Either they didn't do the adjusted basis right, or they gave me only one portion of the character. They gave me the depreciation recapture, didn't tell me about the extra 10,000 that was there. Some people didn't answer what the 10,000 was, which the character is long-term capital. Best of both worlds, right? Because if there's long-term capital, then if it's an individual, it can be a lower preferential tax rate. I guess I would say that there is room for improvement, I would say, that I would want to see. And the final is going to be comprehensive. There's a lot of material in this course. But I think you just got to, what I want to make sure is that you are putting in the time. So I'm happy to talk with you on your exam if you'd want, but those are the themes that I saw. If you want to improve, there is time to improve. This is the same chart that I put up at the beginning of the class. I will start every one of you that want to talk individually about your exam is, are you doing this? Honestly reflect, are you doing this? And I started this off by saying, we spend 3 hours per week together. This is a weekly numbers here. And a general rule of thumb, at a maximum amount, you're supposed to provide 2 hours for each 1 hour in class instruction on the material. And I showed you, hey, one way you could do that is spend 3 hours ahead of time reading the material so that when we talk about things, it's not the first time you heard about it, right? And what I don't think many students are doing is spending enough time after a week's worth of work looking backwards and saying, do I understand it? Did I go back through your notes? Do I need to rewrite that to make sure I fully understand before you advance to the next week's material? Okay? I just put this here, and I apologize for those of you that were Advanced International earlier in this field. But I think this prepares you to be a professional. You're going to prepare for meetings when you're working. You're going to be present in those meetings, not distracted by technology. You're going to look to participate. And then you're going to do a debrief after what the meeting you just had. Are there to-dos? Are there things I got to do? Do I owe stuff to the client? Does the client owe stuff to me? Those types of things. This is the same methodology. So what I did add to this when I was thinking about this over the break is, am I asking too much? This is 15 hours, 9 hours per week for this course. Am I asking too much for you guys? So what I did with this is, just bear with me. My mentor at PwC used to do this with me on my my chargeable hour goal for the year. He'd sit down and work this out for me. So let's say you have 5 classes this semester. Okay, representative full-time class load. And you do this three by 3 by 3 for each one of those 5 classes. So that's 45 hours per week dedicated to coursework. Going to class, preparing for class, and then debriefing yourself after class. Okay? 45 hours a week. Everybody's heard of a 40-hour work week. You're a professional. You're not going to likely work a 40-hour work week. 45 is in the ballpark of that. So that's kind of what that looks like, right? So then, that's not the only thing we have going on. I took the total hours in a week, 24 hours times 7 days, 168 hours. We all got to sleep. Hope we sleep well. I'm going to need 8 hours of sleep. So that leaves us 112 hours that we're awake during a week. If I take the 45 hours off of that you're going to be put forth to school, 67 hours, waking hours per week outside of your coursework. That is 9.5 hours a day. Do whatever you want. Eat, talk to your friends, veg on Netflix, whatever. I think that's completely reasonable. So I don't think I'm asking for too much, but I would just, and I'm not saying you're not doing this, I'm just saying honestly reflect, am I doing all I can do in this course if I want my grade to be better? And I know grades are important, I know they're important to you, and I totally understand that. I'm more interested in you learning the material than just cramming for an exam. But don't rely too much on the note pages that I give you, right? Learning the material. I think if you do this, you will do better in the second half of this course. No doubt in my mind. Okay? Any questions, comments? Arthur?
Since you say that the grades have been curved, how concerned?
Not very much.
Not very much.
Someone got a perfect score on the exam. So you got to be careful. This is a scary course because you do have some of your colleagues that are sitting here that are going to go into tax, and this is the seminal tax course at this university, so they're going to do well in this course. So I compare you to everyone else, and if someone does really well, that tells me there was nothing wrong with my questions, that my questions were good and they made sense. But just keep that in mind. I do curve. But the one thing I did mention in my note to you guys is this is only the 4 corners of the midterm. So if you are participating in class, you're going to start drifting higher. Even if you got an A and you're not participating in class, you are susceptible to drifting lower. Okay, so just keep that in mind. I don't go through and try to assess everybody. It just gets too much work to assess what your class participation is relative to everyone else at mid-semester. Yes?
Final is cumulative, right?
Yeah. It's cumulative, but not in length of the exam, but the material, yes. It's cumulative. Now, and I don't think that that's going to be too difficult for you because I think some of the stuff we're going to go towards, you'll see, is just building on the other stuff. So it's like, if I ask you what's the gain or loss on something, you guys should know what the gain or loss is because it's just like, the earlier stuff is like foundational.
And more focus on the stuff we learn.
Yeah, kind of spread out. When you learn all of the. Anything else? Okay. All right. So I do want to dive into chapter 6. And remember where we left things, okay? So I warned you this was going to be a pretty dense topic today. I find this kind of the most challenging and the most interesting area because every time I sent you 2 updates in the last 2 days because every time I go through it, I refine it and I learn more about it and I think more about it and I try to make it more clear to you. This is one of the slide decks that I think you could keep. Obviously keep all of them, but limited space, you can keep this, and if you get involved in a tax accounting question or something, that serves as a reference material, kind of get you grounded back into the area. So that's why I put a lot of effort into this, and plus it's always been a challenging area. So we did step 1 before the break. step one is identifying all the permanent and temporary differences in order to do the current tax provision, the current tax payable. That is, what do we think we're gonna pay on all of our tax returns around the world on an income tax in the current year? Okay, so that's what we've done. Now, I think steps 2 and 3, which we're gonna strive to get through today, is the deferred piece of tax accounting. I find that the most difficult because my mind instantly grabs onto, I can understand trying to compute my current tax liability around the world. I know what that means. But this is the timing aspect of those temporary differences that we know are gonna reverse and be different over time. The accounting rules make me make journal entries for that. That's deferred tax accounting. And I have to do that as well, because I have to take into account my current tax provision and my deferred tax provision. Deferred just means that's stuff in the future years, right? Step 1 is, what is my current tax return? That's what I'm estimating. Now we're going to start looking at, how do I deal with the future consequences of book tax differences? And then my aim is to do steps 4, 5, and financial statement disclosures on Wednesday. And then that'll be done with our tax accounting, and then we're going to go into M&A type stuff on corporations. Okay, so we're at like page. We're on page 22, so I believe here. Okay, so step 2, we're going to be determining the ending balance sheet balances for DTAs and DTLs. DTAs are deferred tax assets. DTLs are deferred tax liabilities, right? Balance sheet items. Okay? So we're always going to be toggling between entries that are going to be partially balance sheet, partially income statement. Okay? We've got to account for these differences, book tax differences, deferred items, future items in the financial statements. And so recall from chapter 5, we have temporary book tax differences that are either favorable or unfavorable. Remember, my trick on that is I put my U.S. tax hat on. Like I'm the one paying the tax. Something's favorable to me if I pay less tax. Unfavorable if it causes me to pay more tax, right? Relative to book income. Okay? And ASC 740 uses different terminology in place of that favorable, unfavorable language to describe temporary book tax differences, focusing on the balance sheet. Okay? So we are going to be honing in on balance sheet accounts where I have a different balance for book purposes than I do for tax purposes. And the impact of those differences in future periods rather than their impact on the current period. Right? Step 1, we already done. We're looking at future consequences. So the terminology here causes some of the confusion. And I think in hindsight, they could have, my 2 cents, I think they could have used different terminology because I find it very confusing, but this is the language you have. And people may use this exact language, but this is the language that's used in the terminology. So we're going to talk about taxable temporary differences, TTDs. Okay? A taxable temporary difference. So we're not talking about permanent differences, right? Remember, permanent differences are things that will never reverse. It's either included in tax and not in book, or included in book and not in tax forever. We're talking about timing differences, temporary differences that will get to the same ending point. They just get there in a different fashion over time. So we're only talking about temporary differences, and the term taxable or deductible is what is it going to be in the future? If it's taxable, that's unfavorable, right? Because I'm going to pay more tax in the future. If it's deductible, that's favorable because I'm going to pay less tax in the future. Again, all relative to book income. So I put over here on the right, I just equate unfavorable items as taxable temporary differences. Favorable items are deductible temporary differences.
It's favorable, like the deductible, it's favorable in the future?
Yes.
Okay,
Yes.
but which means it's unfavorable now? Or is that not how you would phrase it?
No, I wouldn't add that last part.
Okay.
It's deductible in the future.
Okay.
So we've already done the now. We did the.
Okay, you don't need to like say it's
current
unfavorable
yes.
now. Okay.
So all we're going to be doing is looking at the end of the year
balance sheet accounts.
Okay.
And blasting through those today, and we're gonna go pretty laboriously through this because it's easy to gloss over. I think it's harder to roll up your sleeves and get into it. And it's just those differences and how do we account for those in the future. If they're gonna give rise to a future deduction, that's a deductible temporary difference. It's gonna give rise to taxable income in the future, that's a taxable. Okay, so let's talk about taxable temporary differences, so future income. So from a balance sheet perspective, again, hone in on the balance sheet, the taxable temporary difference generally arises when the book basis of an asset exceeds its corresponding tax basis. Okay? It took me a while to fully accept this because I was such a transactional tax practitioner. Fair market value is irrelevant in this analysis. Okay? We are looking at the book basis and the tax basis. Neither one of those is fair market value. Okay? Necessarily. So it doesn't matter. I don't go and say, okay, this asset's worth $1 million. That's irrelevant to this conversation. What is the tax basis? What is the book basis? We're focused on the balance sheet, and when in the sales price, the deemed sales price, which is really important, is always book basis. So that when I talked about that 1231 asset, right, amount realized less adjusted basis, your amount realized in this hypothetical deemed transaction you're going to do at the balance sheet date is book basis. Don't get caught up on what's the value. Is it different than that? That doesn't matter. You're just deemed to sell it for its book basis. Then, if I did actually do that, what would be my gain or loss? If it's a gain, that means that book basis is higher than tax basis, right? Because I sell it for book, less basis, that means I have a gain left over. I would pay tax on that, taxable temporary difference. If my tax basis is higher than my book basis, then I would have a loss because I'd sell it at book, have a larger tax basis, that gives rise to a loss. That's a deductible temporary difference. You just gotta get out of the real world and into this accounting world. You're just looking at the balance sheet basis. So, I'll give you two types of taxable temporary differences. So let's just say the expense items that are deductible before they are for book. Okay? And I think one of the challenges you have here is reading the words, but then thinking of a real world scenario, what that is. So I try to do that here. The most common example of that is accelerated tax depreciation relative to book depreciation, right? We went through depreciation. All of the tax rules are accelerated methods compared to straight line for book, right? So at the beginning, in the early stages of the asset's life, I am going to have a lower tax basis than book basis because I've depreciated and recovered that basis faster for tax than book. So if I sell it for book purposes, my deemed fiction, tax basis is less than that, that's a gain, right? Taxable temporary difference. Another example, not as straightforward, I like to stay with the depreciation example because it's really straightforward to understand. The installment sale, right? Remember what happens for tax purposes with an installment sale. I get to, it's a tax deferred transaction. I recognize the gain based on the gross profit percentage times the amount of payment that comes in every year over the term of the note. What happens for book? If you sell something for a note, you have gain that year. End of story. Nothing happens in the future. You're just collecting on the note in the future. So the basis in the note receivable is higher for book purposes than it is for tax. The tax basis you take in the note receivable. And by the way, if you have these slides in the, I don't know if you do PDFs, but I have lots of comments on them where I try to elaborate some of this stuff because I have a good thought. I like to write it down so I don't forget it next year. But the tax basis for an installment note receivable is basically the non-taxed portion of the remaining principal balance of the receivable. Okay, so that's going to be less than book purposes because book is going to recognize all the income day one. So you have a higher basis in the note receivable than we do for tax purposes. And here you gotta focus in on what are the assets from these transactions. This is PP&E, for accelerated depreciation relative to straight line for book. This is note receivable, installment sale treatment. Like what gets on the balance sheet by virtue of doing one of those transactions? Well, it's the acquisition of PP&E, or it's the sale for a note, and you're gonna record a note receivable. Buyer owes you money over time. So, this is the fiction you gotta go through. So, I'm just taking from the top here. So the first one is the example of the accelerated depreciation. So our balance sheet item is PP&E, okay? So I buy the asset, say it's 100,000. So book starts at 100,000. I do accelerated depreciation. I just made up these numbers. Can't find these on it. So let's just say 30,000 of depreciation has already happened for book purposes. This is some accelerated depreciation method. It's just the concept here. So the fiction you have to go through is I always settle or I deem sale of the asset for 100,000 in book basis. I sold something for 100,000 in reality. I recover my tax basis, which is 70. So 100 minus 70 yields 30,000 of gain. That's in the future because it didn't happen yet, right? This is make-believe world in accounting. And so it's a taxable temporary difference. Because if that happened in the future, that would be a taxable event. Okay, so that would be 30,000 of a taxable temporary difference. The note receivable in the installment sale treatment, the second part here, that asset, so accounting records note receivable and relieves the asset that was sold as a credit and then records gain, right? So they recognize all the gain up front. They have a full basis in the note. I put here just to make it simple. Let's say the gross profit percentage is 100,000 or 100% because I don't have any basis in the asset I sold. Not the receivable, the basis in the asset I sold was 0, meaning that as I collect on the note, my gross profit percentage is 100% of whatever I received. But none of that happened in this hypothetical. So this is an asset on the balance sheet. My rule is I deem to sell it at its book basis. The book basis is 100,000. What's my tax basis? 0. Gain of 100,000. Because if I went out and sold this note to a financial institution, day 2, I have a $100,000 gain. Tax purposes, because I have no basis in the note. I didn't recognize anything on the sale of the property that gave rise to the note. Right? I was waiting to do that over time. So that is why the rules would have us have 100,000 of taxable temporary difference on an installment sale. Okay?
So does that mean that every taxable temporary difference creates a deferred tax liability?
Yes. Yes. Because as we work through this, I have to these numbers, if these were my actual numbers, my differences between book and tax, I then have to embed that tax effect of that taxable temporary difference on my financial statements. That would be a deferred tax liability because I would pay tax on these amounts. So the only thing I haven't done here is I haven't tax affected these. Right? This is just the gain. Okay, so subsequent recovery of the book basis of an asset via a hypothetical sale at book basis, not fair market value, will cause taxable income to exceed book income by either creating a tax gain, those 2 examples I just showed you on that prior page, PP&E created a tax gain in the hypothetical sale, and the note receivable would have as well, or in the rare case when the book basis in a liability is less than its corresponding tax basis, reducing a tax deductible. That parenthetical. So these can apply on assets. I think that's easier to understand. When I deem a sale of an asset, it's easy for me to do our normal amount realized less adjusted basis gain or loss, right? Well, this applies to liabilities because it applies to both sides of the balance sheet, assets and liabilities. So I can have tax basis and book basis and a liability that differ. That one's a little harder for me to wrap my head around. So I did put this in the comments on the right side as to some examples of what would cause that. But in this instance, I think this is relatively rare when I would have the book basis and a liability less than its corresponding tax basis. I think it's more common to see that reversed. We'll talk about on the temporary deductible. So keep that in mind. When you deal with liabilities, you got to kind of like rewire your brain. This is one instance where I think if you, I don't know if you've done this in your accounting classes, but I think T accounts are really nice. Do journal entries. What happens? What's my debit? What's my credit? Do I have a difference? And where does that go? Does that go to the balance sheet or does that go to the income statement? I think that's really helpful in these areas to try to just map it all out. And I'm talking about this more so than on the exam necessarily. I'm talking about in real life. It's just talk journal entry. Where's my debit? Where's my credit? What happens for book? What happens for tax? And, the good thing is, we all know, debits have to equal credits. So the future tax cost, which is what Arthur was just talking about, the tax-affected taxable temporary difference at 21%, associated with a taxable temporary difference, is recorded on the balance sheet as a DTL. It is a liability. It's deferred because it's not current, right? A current liability is what I expect to pay the next year. This is in the future. My current liability is step one. What do I think I owe on my tax returns? My current tax liability. This is a deferred tax liability. The other side of that journal entry, right? A deferred tax liability normally would have a credit balance. So that's my credit. What's my debit? That's where I jump over to the income statement. That's my deferred tax expense. My current tax expense. That's step one. Credit, current tax liability, debit, current tax expense. This is deferred. So I do the same. I have the same general liability, credit balance, and debit balance for expense, but they're called deferred. That's why our income tax expense is current items and deferred items. This is because the literature wants the reader to understand what's going to happen in the future from a tax-affected perspective. Okay, now shifting gears to deductible temporary differences. So these are items in the future that are going to lower taxable income relative to book income. Okay. From a balance sheet perspective, again, a deductible temporary difference occurs when the book basis of an asset is less than its corresponding tax basis, or the book basis of a liability exceeds its corresponding tax basis. Again, ignoring the parenthetical for a moment. The book basis of an asset is less than its corresponding basis. What do I always do? Deem hypothetical sale at book basis. That's my amount realized, and my tax basis is higher. I have a loss. If I have a loss, that's a favorable item. That's a deductible temporary difference. Future benefit. Okay. So I give two examples here. So revenue items that are taxable before they are recognized in book income. So tax recognizes income before book. Okay. The example I give you here is a prepayment of a subscription. So if you subscribe for something and it's going to be given to you, your access, like streaming, I think we all do that on a monthly basis, but let's say you sign up for a streaming package and it's for the next 12 months, right? Tax would, that company that is the streamer, Netflix, tax would normally tax Netflix on day one on the receipt of the cash. Usually it's very difficult to receive cash and not have a taxable event. Usually pay cash and receive the cash. For accounting purposes, we're going to recognize that income over the subscription period. So I might have recognized the revenue on the tax return quicker than financial statements. Okay? So that would be an example of a deductible temporary difference because I'm going to reduce my future taxable income relative to book. The second item, which I think is pretty intuitive, expense items that are deductible for tax after they are recognized for book. The best example I have of that is bad debt expense. Remember what happens for accounting purposes. Accountants estimate the allowance for bad debts and take that on estimates based on historical information. 2% accounts receivable is never gonna be collected, so they take a bad debt expense for that. You guys know the tax rule is we don't go by estimates, right? We need actual detailed account information level items that account itself is not collectible. Because I can't find that person, or they've left the country or whatever, I can't collect. Then I'm allowed a tax deduction. So usually I have an acceleration of expense for a book relative to tax. Tax lags, waiting for more concrete information. Okay, so again, on each one of these things, think of the balance sheet account that's affected. And the second one, bad debt expense, that's accounts receivable. Right, the net balance of accounts receivable, the gross amount less the allowance amount. That's the asset you're dealing with. On the top one, the prepayments of the subscription, that's deferred revenue. That's what you would find on the balance sheet, because that's when the transaction happened, cash came in because the customer paid for it. That's a debit to cash. And the credit is deferred revenue. That's the liability for accounting purposes that I have to provide this service to recognize the rest of the income. Right? That's the liability. So doing that same thing we did with taxable temporary differences, we're going to do with deductible temporary differences. So for that deferred revenue item on the prepaid subscription, so book has a balance on that, has a book basis in that liability of $100,000, right? Think of the journal entries that was created. Again, I got cash in at the start of the subscription for $100,000. I haven't yet provided access to that, whatever that is, 12 months, 16 months, whatever the subscription period is. So they set up a deferred revenue account that's on the balance sheet. Right? I'm not recognize that until earned. Okay? For tax purposes, I would likely have a zero basis in that asset. Because I've already recognized the income. What was my journal entries for tax purposes? I debited cash because that came in the door. I credited revenue because the tax rules are going to accelerate the recognition of the revenue. That's on day one. So I don't have anything on the balance sheet for deferred revenue for tax purposes. So when I look at my book tax difference, I see, oh, the accountant showed me $100,000, and I'm like, I don't have that for tax purposes. I already recognize that income. So I have a book tax difference of that $100,000. So I settle the liability for the $100,000 because I always do it for book basis. Zero tax basis, so that's $100,000 of deductible temporary difference. That future settlement of the liability would create a tax deduction, reducing taxable income. So since this is a liability, you're kind of in this alternate universe. So what would be the scenario that would cause this? Let's say transaction happens, and as I mentioned, I get $100,000 in the door, and books sets up a deferred revenue. And then let's say I don't provide the service, like Netflix has a network outage and cannot provide the service, right? So they have to give back the $100,000 because they can't provide. And again, I'm just trying to explain to you what methodology of why this could be the result. So what would be the journal entries to give back a refund of the $100,000? So they had not recognized any income yet, right? Because they hung it up on the balance sheet. They got to obviously credit cash because they got to give that back. We're going to just debit deferred revenue. Get that off the balance sheet, right? Nothing went through the income statement. What happens for tax? Well, for tax purposes, I already recognize the income. I have to have an entry through the income statement to reverse that. So the same thing as book, I'm going to credit cash because I'm going to issue a refund. My debit is going to be loss or something to offset the revenue that I recorded on day one, right? So that I'm neutral from a tax perspective. That is the deductible temporary difference. And to me, that's why it's a little strange to think about it in a liability setting, but that's where you have to think about a liability. It's deemed settled at book basis, but what is your tax basis in that? The best way I could think through that is just think through what that transaction would look like from a debit perspective. I think the second one's easier to think about. So accounts receivable. So this is the bad debt example. So say my book basis is, sorry. My My book basis is 90,000, and my tax basis is 100,000. Why? Because books set up a allowance for bad debt accounts based on estimates. That's likely higher than my direct evidence to write off receivables as bad debts for tax purposes. So my book basis is lower than tax. What's my rule with assets? I'm deemed to sell that asset at book value. If I sell that accounts receivable to a financial institution, I'd sell it for 90, that's book value. My basis is 100, it's a $10,000 loss. Normal tax rules, right? That's a deductible temporary difference because it would be a deduction in the future if I would have sold that asset at its book value. Subsequent recovery of book basis of an asset via hypothetical sale or settlement of the liability will cause taxable income to be less than book value by either creating a tax loss or creating or increasing a tax deductible expense. That last part, creating that taxable income loss, that's the deferred revenue example. I have to create something, my debit, to offset my credit that I did for tax purposes, which was revenue. I recognize the revenue, so I got to have a loss so that over time I didn't have any net. The future tax benefit, just like what we did with the taxable temporary difference, is the tax affected deductible temporary difference times 21% associated with that difference. It's recorded in the balance sheet as a DTA, deferred tax asset. The other side of the journal entry jumps to the income statement. The same thing as what I just did on my taxable temporary differences. It's deferred tax expense. So I use the same income statement account for my taxable temporary differences. It's just one, my balance sheet account is different, my DTA and DTL. So when I set up a DTA, right, it's an asset, so it's normally a debit balance. I'm crediting deferred tax expense. What happens when you credit an expense? I'm lowering the expense, right, because it's normally a debit balance. So DTAs are good guys, favorable, right? I'm future deductions. That's lowering my deferred tax expense. If I have a bad guy, a taxable temporary difference, that is increasing my future tax, that's going to be a debit to deferred tax expense. This is why when you put all this together, when you're doing tax planning for a corporation, if you're talking a temporary item, it's not going to affect their effective tax rate. It's going to go through the deferred items. So accelerating a deduction or deferring income is a good way to save cash tax, but it won't save book tax expense by virtue of these journal entries. And that's why if the client you're talking to is all focused on earnings per share, then giving them temporary items may or may not get their attention, because the CFO and the controller are going to say, well, it doesn't affect my effective tax rate because it's going through my deferred items, deferred tax expense. Whereas I had one client who was very, very interested in temporary differences that were favorable to them because they were all about cash. They were trying to raise cash to pay down debt. So book ETR took a back seat to cash flow. It just depends on your client. It doesn't make one of them right or wrong, but you just gotta kind of know who you're working for, or who you're advising as to what's most important for them from a planning perspective. But this is the reason why temporary planning doesn't affect the tax rate. It's going to run through the deferred tax expense. Okay. So that's it. I would look at my balance sheet and I would go through each item on my balance sheet. What's my book basis? What's my tax basis? We're going to go through that in some examples here shortly. But there are other items that are deductible temporary differences that are not found on the balance sheet. That's because accounting doesn't put that on the balance sheet. Okay? So think of these as our carryovers. Okay? Remember we talked about carryovers where something happens and I can't deduct it in this year, but it doesn't go away. It just goes over to another year or it goes back to a prior carryover amount. Accounting has no such thing, right? They'll look at you like you got two heads if you're going to carry an item over to another year, they're like, oh my God, that sounds like fraud. Can you move an item to another year? Tax purposes, we have rules that say you can take an item and put it in another year. Okay, so think of net operating losses. That's when my current year has a loss. Accounting just says, well, that was a bad year. You had a loss. Done. I start the next year. Tax says, well, that loss can carry forward to that next year and offset that taxable income. But the reason it's not on the balance sheet is because accounting's done with it. Right? I don't put any asset on the balance sheet besides what we're going to talk about here on the balance sheet for losing money. Right? In a year. I start the next year fresh. So these items, these carryover items, must be tracked to ensure that the appropriate adjustment is made to the company's DTAs when the carry forward is used on a future tax return. Okay? So when I use the tax attribute in the future year, I have to then make sure I've reduced the amount of it, right? And we'll show you through the DTA analysis here. Or when facts change and no longer support the future use of the carry forward, which then necessitates a reversal or a write-off of the DTA. So I'll take loss carry forward, capital loss carry forwards. Remember, capital losses for a corporation can only offset capital gains. If I have an excess capital loss, then it goes back 3, forward 5. So assume I have no carry back potential because there's no capital gains in the prior 3 years. So I'm in the middle of carrying forward it for 5 years. You'll see I set up a DTA for that because that's a future reduction of tax when I use it. But what happens when I get to year 6 and I haven't used it? The DTA has expired. It's like any asset on the balance sheet, and I can't carry it on the balance sheet greater than its fair market value. Credit deferred tax asset. Where does my debit go? Income statement, tax expense. I lost something that was of value because it expired. Okay? So this is the reason I have to separately track my carry forwards so I can use those as well. So I look at the balance sheet for items that are on there and then I say, oh yeah, do I have any carry forward items as well? And I may have none because maybe it's a completely profitable company and they'll have carry forward. But if I have losses or capital losses, then I may have deductible temporary goods. Okay, so this all points out the need for a tax basis balance sheet. You will have a financial statement balance sheet, right? You have to, especially a publicly traded company. But you're not forced to have a tax basis balance sheet, right? There's nothing. When we do our tax returns, we're doing income statement, right? It's gross income less expenses. There's nothing balance sheet in that. But as a best practice, you need to maintain a tax basis balance sheet because you'll see when we go through these examples, you're going to be comparing book and tax as of the balance sheet date for each line item. If you don't have that, then you're kind of working against yourself a little bit. You have to recreate that if you don't maintain it on a current basis. So the companies that are really good at this and have some religion in this area is they are maintaining a tax basis balance sheet. It's a lot easier to do these rules when you can do that. And so tax basis of assets, so I'm talking about assets on the balance sheet here, often differ due to differences in depreciation methodology, or we may be doing straight line for book, accelerated for tax, or differences in purchase price accounting. Remember we talked about if I buy stock, accounting is stepping up the assets anyway. I don't step up the basis of stock. I don't step up the basis of underlying assets when I buy stock of a corporation. Okay? If I buy assets, I step up both. I start amortizing them, but remember I could have a difference in goodwill. I could have a difference in the recovery periods of those. And I could have differences in accounts receivable basis due to differing methods to account for bad debts. So those are the common examples for assets. When I get to liabilities, this is less straightforward, as I've been saying, with an obligation constituting a liability for tax purposes only if the liability creates basis in an asset. Think of if I borrow to buy property, plant, and equipment. But my borrowing, my liability created an asset on the balance sheet. Now I have tax basis in that liability. or it results in cash generation. So if I just borrow cash to use in my business, I've created an asset as well for purposes of borrowing. Or it provides an immediate deduction. So think about recording accounts payable for an expense that is currently deductible. So if I have to pay for paper towels for the office, it's going to be immediately deductible in the business, and that accounts payable when I have to pay the vendor for that, then that I have a basis in that liability for tax. And the last one is if I have a non-deductible expense computing tax benefit. So think about a fine. Like if I have a fine, a regulatory rule or something, so the business is fined, that's a deduction for accounting purposes, right? It relates to the business, but we don't get a tax deduction. The government doesn't subsidize us for fines because they don't want to be subsidizing Corp costs there. But if I accrue that liability for the fine, I still have tax basis in that liability. Yep.
Is there a situation where companies buy companies that are making losses just for the tax benefit?
Yeah, so we'll cover this, I believe, in the M&A section when we get there. But that is a concern of the government, is if I have a profitable company and I go out and I buy a company that is contains operating losses in it, like I carry forward, then the question is when I combine the companies and file a single tax return post-acquisition, can I use that loss to offset my historic profitable income? The answer is yes, but it's limited to the amount. So the government does want you to use some of the losses, but they limit it because they don't want people buying companies solely for losses and utilization of future losses. And so we'll cover that. There's a complicated limitation that's associated with that. But the answer is yes, you can use some, but not all. Yes, Clark.
Just to use your phrase, tail wagging the dog. Wouldn't that be like a tail wagging the dog situation where you buy a company that's loss making just to save the taxes?
Yeah, which never happens.
Yeah, it's easier than much.
Right. In my experience, there is business rationales for why you buy a company, but I think what the rule is premised on the government doesn't want to incentivize you to purchase a company, maybe pay a little bit more because it's got losses. I don't think you would do the whole transaction just for the tax benefit, but if you were going to pay $100 for the company and you thought, oh, they got losses, I'll pay $110 for the company to make sure I get it because then I'm going to utilize that loss. That's where the government wants to just limit the future use of that loss. Okay. All right, let's work through these examples. I think this will hopefully tie it together for you guys. 6-8, Ethan, you got this one? And I want to kind of go through these pretty methodical because I think it's easy to gloss over the numbers, but I want you to see where the numbers are coming from and what we're doing. If not, this
BCC is provided its both and tax-based balance sheets. Louise identifies the differences in balances in several accounts. She isolates the accounts with differences that determine taxable and deductible temporary differences and the deferred tax liabilities and deferred tax assets. Louise summarizes the differences and produces the following table below. Why is the tax basis for the reserve for warranties and deferred compensation zero?
So let me pause you there for a moment. So before we get there, we have accounts receivable and fixed assets, right? That's our bad debt expense is causing an issue there, and our accelerated depreciation is causing a difference in the basis. So just look at beginning basis. So I have book basis of 16.9905 for book purposes, and higher tax basis of 17,250, and this is accounts receivable net of allowance. Does that make sense? Yes, because probably what is happening is they are estimating the allowance for bad debts at a higher amount than is specifically deductible for tax purposes. So you would expect tax to be higher than book. And that's the case at the end of December 31 of 23 and the result at the end of 24, tax is still higher than book. So now going to fixed assets, End of year 23 is 47,900 for book and 35,500 for tax. Does that make sense? Yes, because this is again net. This is probably because I'm taking accelerated depreciation for tax purposes, lowering my tax basis relative to book basis, right? And that's the same at the end of December of 31 of 24 as well. So those two make sense to me. I would expect that to happen, but she's just taking a snapshot in time because these are balance sheet balances as of the end of the year. Right? Okay, so move on to warranties and deferred.
Yeah, well, they're not book liability, either of them, because that's a tax liability, because warranty reserve and deferred compensation don't provide immediate tax deduction because of related funds don't meet the events test, and they don't create a tax basis. And they also don't meet the other two criteria because they don't create a basis in cash, and they will both eventually be removed.
Yeah. So these are liabilities, so they're have brackets around them, or parentheses around them. That's what she's doing her debits and credits. So the reserve for warranties, right? That's a estimate again on the management side, saying, hey, we expect these amount of warranty expenses, so they accrue that on the estimate, which is perfectly fine. That's not, you don't get a deduction for that until you actually service the warranty. The tax rule, right, has more rules associated with it before you get the deduction. You need actual economic performance, i.e. satisfaction of the warranty. Somebody coming forward, making a claim, and you doing it, that's the deduction. So I don't have any basis in that liability for tax purposes because it's not real yet for tax purposes. Same thing for the deferred comp. I only get a deduction on the deferred comp when it's paid. Accounting is going to accelerate that and make an estimate and put it on. So she's examined her balance sheet and come up with beginning of the year, end of the year, book basis and tax basis. So now she knows her book tax basis. Right? Okay, thank you. Okay, 6-9. Who's got 6-9? One.
So for 6.9, what are PCC's taxable and deductible temporary differences at the beginning and end of the year? And what is the change in the cumulative temporary differences? So the table is basically view of the one from last question. So for account receivables, we got like at the end of the year using like the tax basis minus book basis, we got 415.
So let me pause you there. So that is at the end of the year. So that's the 20,335, and she's doing tax less book. So that's the 20,750 less the 20,335 gives you the 415. Right? Okay. I just want to make sure everybody knows where the numbers come from. Okay.
Yeah, and we use the same method to get the amount like at the beginning of the year. Then we do the changes in cumulative temporary differences using like the ending of the year minus the beginning of the year. For account receivable, we got like 70.
Yeah, so that's saying the book tax difference started at 345 and it grew to 415. So now it went up by 70,000. Right? And this is important because this goes to my point about how some of you were dealing with the question on the exam, the midterm, as you were doing the cumulative balance here instead of the year by year, which is okay. Not technically what I asked, but that's fine. But that's what you have to do in this step is hone in on what is the balance sheet change, what is the increase or decrease in that book tax balance.
And the changes is like 70,000, so like it's positive, which means like the tax basis is over the book basis. So we all consider that it as like a deductible temporary.
Yes.
And use the same method for the next three. For the fixed asset, we got the changes is like negative 684,000. For the reserves for warranties, we got 170K. For deferred compensation, we got negative 50.
Yeah, and so those last two was just the growth in from beginning of the year to end of the year. So accounting increased the reserve for warranties and the deferred comp. Neither one of those is on the tax basis, so they both grew. Okay, 610, who's got 610? I try to put it in a bubble here, just so when you're going back and reviewing these, I think you gotta review these sequentially, obviously, but look at them all at the same time, because it's just building on top of each other. It's just a very process-oriented section of the law.
As you stand there, we also noticed that some items are missing from the temporary items she identified with the solution. Which temporary differences are missing, see exhibit. So in the previous two questions, we identified the line items that has a tax basis, and the first one we found the differences, and then the second one we found like what is the change of the tax and book value. So in this question is more about like the items that are not able to be directly tracked on the balance sheet and will be listed out separately.
That's really important, all right? The prior example, all of these items she found on the balance sheet. Remember when I was talking about the coordination? She walked down the hallway, got this when they were done at the accountant level, and said, okay, here's your the balances that I'm interested in, and I'm seeing if I got any tax basis in those items. But she started with the book basis. The items that you're going to go through are not on the financial statement, so you have to separately track these. Okay.
And there are three missing items: NOL carryover, net capital loss carryover, and charitable contribution carryover. And this will result in a difference in the tax value.
Yeah, so this is where I pause and just look through and see what is happening here. So take the NOL carry forward. I started with a $24,000 NOL carry forward. I ended the year with 0. What does that mean? That means I used that. Current year I had income in excess of $24,000 and I used it. Right, so it's gone. Balance is 0. Net capital loss carry forward. I started the year with 0. Now I end the year with $28,000. I had a capital loss, but I did not have capital gains. It's in $28,000. Same thing for charitable contribution carried over. So we haven't talked about that specifically, but there's a limitation on the amount of charitable contributions the corporation can make. So I started off with 0. I must have made a big, large charitable contribution, and I got limited, meaning some of it's going to carry forward 73,000. So that's an increase. Okay. 611.
So Elisa's next steps are to determine the deferred tax assets and liabilities to be included on the financial balance sheet. So the other parts of the problems were doing that math, but now we're finally getting the DTL and DTA. So using the temporary differences from example 6.9 and the enacted tax rate of 21%, she determines the beginning and ending DTAs and DTLs. The first section of this table is the balance sheet items. From 6.9 for all of these, for the ending and beginning balances, you're multiplying it by 21%, and that's where those values in the table come from. So if we were to go back to 6.9 and then multiply those numbers by 21%, that's what that would be.
So let me pause you there. So if I go back to 6.9, so if I go back to 6.9, that's simply these positive and negative numbers tax effective, right? Because I want to look at what's the tax impact of these differences, not the difference, right? The difference is not what's relevant, it's what are they going to be recovered at? At what rate is the future deduction going to be worth to me? Or what is the rate of the future tax going to burden me? And that's going to be the tax affected number. So the example you're going through is taking just all of those line items times 21%. And it's so simple because it's 21%. Now, just to scare you a little bit about how this gets complicated, you're doing this on a multinational in every country in which they're doing business, right? So Germany's going to have a different rate than 21, but it's the same concept. You have to have book basis and tax basis and compare the two. So think about 50 jurisdictions all running together in a short period of time where all this has to get put together on a consolidated financial statement. That's where people can get a little bit hairy.
And then, what my question? I was wondering, so you add them all together at the end, it says those are the ending DTA and DTLs, like which one's which?
Yeah, so the way she's doing it is, I think the DTLs are positive numbers and the DTAs are negative numbers.
These are
go through this. You just gotta, and whatever worksheet you pick up from somebody that's handed it to you, you gotta make sure you're oriented the right way. They're doing positives and negatives, or you're gonna get tripped up. So here she's got the DTLs as parentheses and the DTAs as positive numbers. Okay, so the point is on the, so that example was very straightforward from a rate perspective, because what's the rate in the United States for, we're doing this for United States deferred tax accounting, and what is the rate currently and what is the rate expected to be in the future? It's 21, right? The 21 is permanent in nature, meaning that it will be the law unless they affirmatively go in and change it. So it's not, it doesn't sunset or change by the mere passage of time. Okay, so what this example is saying is when I do have a change in the tax rate, I have to make an adjustment to my DTA balances and my DTL balances because I recorded those at a certain rate. If the rate has changed, then I have to make an adjustment to that. And I need to revalue those when the enacted income tax rates change. Enactment means all the things that have to happen for the law to be effective. In the United States, that's passage by both houses and signed by the president. It doesn't mean that, oh, it's on the desk of President Trump and he said he's going to sign it and he hadn't got around to it. He has to sign it. Every step has to be. And so the reason I'm methodical about that is because that's going to be the same rule around the world. So what all has to be done in Germany? What has to be done in China for that idea or proposal to become law? Until it becomes law, you can ignore it. Doesn't matter how certain it's going to be law. It has to be the law. And when it's the law, you have to adjust the balances if the rate has changed. Okay? So here, this example I think is pretty interesting as to what happened. So our last big change in the corporate tax rate in the United States was the Tax Cuts and Jobs Act of 17. As you guys know, Trump 1.0, the Republicans lowered the tax rate from 35 to 21. Okay? Berkshire Hathaway, one of the largest companies in the world, quoted this article, $29 billion gift from Congress. Don't put a whole lot in the words of the title gift. Okay, it's not a true gift. We know. So what I underlined here is at September 30th of 2017, so the law was going to change as of 1/1/18. The Tax Cuts and Jobs Act enacted in 2017. So Berkshire Hathaway had a net deferred tax liability. What does that mean? I'm going to pay tax in the future, right? It's deferred in the future, and it's a liability. It's going to cost me money. But they had that tax affected at 35, right? Because that was the tax rate at the time they had these journal entries done. So when the law changed, went from 35 when they reduced the corporate tax rate to 21, Berkshire Hathaway was required to revalue the liability at 21. These items were going to reverse in years where the tax rate is now 21. I have a liability that's too high, the credit balance is too high. What do? I debit the liability to lower the balance. What's my credit? For tax expense, right? I'm going to toggle over to the income statement. So yes, I got a gift. I got a financial statement reduction in my tax expense, my deferred tax expense, by virtue of taking my balance from my balance of my DTL, tax affected at 35, now I need to tax affected at 21. That's a huge, quote, gift for financial accounting purposes. Now, sophisticated analysis, or analysts would go through this and say, okay, that's a one-timer, and that's just accounting doing their accounting stuff, and it's not replicatable, and I'm not going to take into account for that when I value the company. So the $35 billion reduction in the balance sheet basis would be accompanied by a decrease in deferred tax expense of $34 billion, thus increasing net income after tax by $34 billion. So, this just has to be done. That's the last big example that we've had this, but you can have this around the world as well when they change tax rates. You have these things that are recorded on the balance sheet either as an asset or a liability. If this was a deferred tax asset, it would have got hit by $34 billion, right? Because the asset was going to be reduce tax at 35% on my old balance sheet. My new balance sheet, it's only going to reduce tax 21%. So I had to lower my deferred tax asset by crediting asset. What's my debit? Deferred tax expense. It's a bad guy. It hurt me. Right? So just want to make sure you're aware that I have to, it's the enacted tax rate may cause me to revalue my DTLs. Okay, my deferred tax expense or benefit, right? Because I'm making entries to my deferred tax expense. I'm doing debits and credits, depending on what has changed in my deferred tax assets and deferred tax liability. So I could have a benefit. Portion of my total tax provision reflects the change during the year in DTL and DTA balances. This information our attempts to provide users of the financial statement with a measure of the company's expected future income tax related cash outflows or inflows resulting from temporary differences. That's why we're doing this. We're trying to give some measure to readers of financial statements as to what are these items going to mean in the future from a cash flow perspective. Am I going to have to pay a lot of tax in the future? Am I going to have to pay a little tax in the future? We've got these deferred tax assets. That's why we're doing this. So once I got the beginning and end of year DTAs and DTLs, which we did in the last example, calculating the deferred tax expense or benefit is relatively straightforward. It constitutes the change in the net DTA or DTL for the year. An increase, so ignore the parenthetical for a moment, an increase in a net DTA produces a deferred tax benefit. Right? Because if I increase my DTA, think of my journal entry, debiting deferred tax asset, credit, toggling over to the income statement, or reducing deferred tax expense. That's a good guy. If I do the parenthetical, if I decrease a DTA, then I have to credit deferred tax asset. My debit toggles over to the income statement is a deferred tax expense. Right? So I'm effectively using my deferred tax asset, right? An increase or decrease in a net DTL. If I'm increasing a net DTL, that provides deferred tax expense because I'm going to debit the liability, deferred tax liability, make it go up. Credit this income statement, deferred tax expense. If I decrease a net DTL, then I am debiting the deferred tax liability. My credit is a benefit. So let's finish off our examples. Who's got 6 to 12?
Okay, so this example reads, Elise now has the pieces to determine PCC's deferred income tax expense or benefit for 2025. Using the solution from example 611, what is PCC's deferred income tax provision for 2025? So as a reminder, these pieces that the problem is referring to are the beginning of year and end of year DTAs and DTLs that we just calculated in the last example.
Yeah, so let me go there a minute. So if you go to 611, you see there's in the ending number here, there's only one minus number. And so that's 2.751. You go to the current example, that's the 2.751. All those other items were positive, they sum to the 455. Okay, so that's where they're coming from. Is they're just summing all the deferred liability items and summing all the DTA items. Okay? Beginning and end of year.
Yeah, so this first column of the table reflects the calculation of the end of year net DTL. So that's the netting of the $455,007 DTA and then the $2,751,000 DTL. And then the second column of the table reflects the calculation of the net DTL at the beginning of year. So same thing, and then we arrive at a net DTL of $2,187,570. And then the change between the two of those is an increase of $108,423. And since that's an increase in a DTL, that reflects our deferred income tax expense for the year.
And increase.
Yes.
Yeah, because I'm going to credit my liability to get that up. I'm going to debit the expense. Perfect. Thank you. Okay, so 613. Who's got 613? What?
So now what is PCC's total income tax provision for 2025? You can see that the current income tax expense was $1,180,557.
So let me pause you there. So that's from example 6.1. That's step 1 of what we did. That's what I expect to pay on my current year tax return. Right? I did all my book tax differences. You did what I think my taxable income is times 21, but that's the 1.18.
And then the deferred income tax expense was $108,423, which leads to the total income tax expense of $1,288,980.
And so that 108 is from Megan's example, which was the change in my net DTL at the end of the day. We'll do the journal entries at the moment. But it's the sum of those two, which is my total income tax expense. So I will show on my income statement my current expense and my deferred expense items on there. That'll tell the reader of the financial statement what is my current year item and what is my future year item. Okay. And then our last example, 615. Next 615. We're on the perfect trajectory. Ethan, you got 450, 650.
Yeah. I think we make it this far.
It's okay. These are just the journal entries that kind of wrap this all together. Because again, I want you to think in terms of journal entries here. This is what you're going to. This is what's going to be called from the tax professionals with the accountants is to tell me what this journal entry is.
What tax accounting journal entry is least made to record PCC's current income tax? The answer is they will debit current income tax expense for $1,138,557 and credit the income tax payable for the same amount.
And you might see that be called the credit be called current income tax payable, but that's the amount I expect to pay this year, right? On all my global income tax returns. So that was pretty simple. That's step 1. We give you this journal.
What tax accounting journal entry does least make to record PCC's deferred income taxes? They would debit the deferred income tax expense of $108,423 and the additional tax asset of $35,217 and take some of that to balance with the credit of the tax liability.
Yes, and that should be these entries here from the example that Megan did. I have a DTA that needs to go up by $35,217, so that's a debit DTA. And I have a DTL that needs to go up as well of 143, but that's a credit balance. So if you go to Ethan's journal entry, I credit DTL, this is deferred income tax liability, but DTL of 143, and I debit deferred tax asset of 35,000, and the delta goes to deferred income tax expense of 108. That is my journal entries, and I'm done, and I run off to happy hour because I finished my tax. There's a lot that goes into that, right? And a lot of prep for this, and a lot of religion about the process. You start cutting corners, and that's where things get mixed. So the best thing I can tell you on this stuff is, I think this is not something you learn like overnight. It takes a while. Lots of different touches on this stuff, but you're going to be in meetings if you're in this area, hearing people talk about this stuff. This is great for asking questions. Some of these people go very fast. You're like, hey, I didn't understand that thing about the reserve for warranties. Can we go through that real quick? Great way to learn this stuff. Okay. So we will pick up with steps 4 and 5, which I think are a little bit lighter. Okay? Yeah.
我一会儿出去也是一个有挑战性的事情。我要去吃饭，我真的烦死了，我要去吃饭，好远啊，我想回家了。今天怎么会这么冷？Yeah, I gotta pee. Not me. No, I was joking. I was like, oh, it's him, it's him. 研究一下那个老师要干嘛 ？Martin。